What is up, YouTube? This is the Working Investor. Did you know that there's another company that rivals Yieldmax? And also, does it make sense to invest in the Yieldmax ETFs versus just the underlying by itself? So there's this company called KURV, KURV, and they have, let's say, for example, we'll compare AMZY, which is a Yieldmax Amazon synthetic cover call ETF, to AMZP, which is the curve yield premium strategy of Amazon. So they have very similar underlying. So just a little overview of Curve. They basically have like the the Amazon high yield, Apple, Google, Microsoft, Netflix, and Tesla. And then they have this thing called KQQQ, not the best name of choice, but they call the Titans, which is basically, I believe, a fund of funds of these funds. Sounds very similar to YMAX from Yieldmax. But if you look through it, you'll see that they're kind of not that great. I mean, they don't give out a lot of premium. If you look at their they're giving around 32 cents. You can see here 32 cents per month. So I did a little bit of a comparison. Yes, sorry for all the words here, but this is good to know. So right now, AMZP, for example, is trading around $29 a share. And I went through their mode of dividends. They give around 32 cents dividends. If you multiply it by 12, it's $3.84. And if you divide, 384 divided by $29 times 100%, it's about 13.24% dividend yield, which is not that great. It's kind of, compared to Yieldmax's AMZY, this kind of is like inferior. But then you can argue that the NAV actually from the AMZP is up 13% year over year, compared to, and we'll get to the AMZY. You'll see like AMZY gives 45. We can do a side-by-side comparison. So AMZY is roughly $20 a share. They have 45% dividend yield versus 13.24. Their NAV, the net asset value, AMZY is up year over year about 1.8% as of today, as of now, versus 13%. So you can argue that AMZP is better because it's 13% up versus AMZY. But we'll get to the bottom, you'll see the conclusion. The expense ratio is a little higher, 1.15 versus 1.1 in Yieldmax. Here's a shocker. There's very little liquidity. I looked at how many, as far as liquidity, only 1,300 shares are being traded per day, which is nothing. I don't think I've ever seen a company with such poor liquidity. Versus AMZY, which has better liquidity or good liquidity, which is 300,000 shares average being traded per day. So let's talk about total yield. Let's say we're going to add the yield of the dividend and we'll add the yield of the NAV that it gained over year, and that equals 13 plus 13 is 26% over the past year. Versus AMZY, which gives you a 45% dividend yield and a 1.8% in NAV. I guess it's 1.8 would be around 46.8% up over the year. So definitely I would say that AMZY is the winner compared to AMZP. Now the question is AMZY better than just holding Amazon? Because what's the point if if it's underperforming? So if you look at Amazon year over year as of now, pre-market, you'll see that year over year, it's up about 40% if you just did the buy and hold method in Amazon. So AMZY is still outperforming Amazon as of now by 6.8%. So that's quite impressive. Now the question is, from the Magnificent Seven, ones that I do, I have to rethink my strategy because I was comparing the underlying of the Yieldmax, to the actual stock. And if they underperform, then the question is, why do the high yield Yieldmax underlyings if you could just hold the actual stock? So for example, Microsoft is up 19% year over year. MSFO, which is the Yieldmax one, is up 20%. Zero in NAV. It didn't really move. It's negligible, like less than 1% plus or minus. It's pretty much nothing in NAV, but you got 20% in dividends. So here you're making 20%. If you held Microsoft, you're up 19%. Of course, this is all including with the fall in the market. My conclusion is, should I dump Microsoft or keep Microsoft? So I'm undecided at the moment. I'm maybe I'm undecided. AMZY seems like it's a hold. AMZY seems like a hold. Let's also compare Google. So Google is up 36.8% year over year if you held it, Google. But GUI, which is the Yieldmax ETF, went up 20%, there's a minus there. It lost 20% in NAV, but it gained 33.5% in dividends. But then if you subtract the 20% from that, you're left with 13.5% year over year. It should be year over year. So it sounds like it's better. You're better off holding Google by itself and enjoying 36.8% year over the past year versus holding the Yieldmax synthetic cover called underlying, where you're underperforming. So right now my conclusion is that I want to sell out of my Google position, my GUI position, because I feel like it's not a worthwhile endeavor for me. One thing to note as well is that when you get the dividends paid out for you month over month, that triggers a taxable event, and then you have to start paying taxes on it. And then if versus having a paper gain, unrealized gain, you can just hold it, and it does not trigger a taxable event until you decide to sell, and you could just choose to sell after 1 year, where it would be long-term capital gains. So not only does Google outperform GUI, but also you have potential to take the profit after a year and a day and enjoy a better favorable tax treatment. Let's talk about NVIDIA. I only have a couple more to go. So NVIDIA is up 145% year over year as of today. NVIDIA, which is the Yieldmax for NVIDIA, increased 10% in NAV, which is pretty impressive. So far, if you compare it to AMZY, which is like 1.8%, this is 1.8% in NAV. This is 10% NAV. But it also delivered 114.5% in dividend yield. So if you add them up together, it's 124.5% return. So yes, holding the NVIDIA would gain greater than holding the NVIDIA, but I would still say 124.5% return is pretty darn good. So as of now, I'm thinking of possibly holding it for now. Although I know that people are saying the AI craze is over, or AI was overpriced and maybe it'll regulate, but we shall see. That's a different discussion. Let's compare the good old Apple to Apply. So Apple, basically, Apple stock itself provides like a teeny bit of dividend, which is 0.46% as of now. And also Apple was up year over year 12.33%. So total return over the year over year is about 12.79%. But Apply actually lost in NAV, 20.5% loss. But then it returned in dividend 21.7%. So you're getting a measly 1.2% return. So you would have more than 10 times greater return of owning Apple by itself than just holding this Apply. When before I went on this venture, I was doing my own wheel strategy with Apple and other companies, and I didn't lose NAV. You know what I mean? Like, that's kind of sad. So my conclusion is, for Apple, it's a sell. For Google, when I say Apple, I mean Apply, because sometimes certain underlyings are better to hold the actual underlying, and certain ones are better to do to do synthetic cover calls. I mean, I guess it depends on implied volatility and whatnot. Not every single company, even though some companies are super solid and amazing, some companies are not worth doing certain strategies with. It wouldn't be favorable. Not everything fits into one umbrella, if that makes any sense. So yeah, so Apple is a sell, GUI is a sell, AMZY is a hold, Nvidia is a hold, and I'm undecided on MSFO. I just wanted to share with you my little bit of research and my journey. This is the Working Investor, over and out.